Yes, actually you're right. Asian bonds have rallied a lot in 2019. So for the next 3 months, we actually expect the yields to stagnate here, especially on the US dollar bond side. We don't expect a big rally on the either the government bond on US dollars or the corporate bonds. But one thing we do expect is the local currency government bonds. We expect actually countries like India, Indonesia and Philippines to cut rates by 25 to 50 basis points. So we do expect local currency government bond market to rally. But however, on the US dollar credit space, both for high grade and high yield bonds, we don't expect a rally. We expect kind of a carry game rather than capital appreciation. So for the next 3 months on the Asian US dollar bonds, we expect a carry but no capital appreciation. But for local government bonds, we do expect some capital appreciation. Okay, basically, as you said, central banks have been doing a lot of QE and cutting rates. So what we've been doing with the portfolio is we've been raising more cash, and actually we've been reducing the duration. As you know that long end bonds have rallied massively, or anywhere between 50 to 100 basis points. So we expect that for the next 3 months it's better to keep short duration rather than long duration. So we've been reducing the duration. So at the beginning of the year, our duration was about 5 to 6 years, but now we are reducing the duration between 3 to 4 years, and I think we'll continue to maintain this duration of 3 to 4 years as we expect the long end to sell off more going forward. Okay, in the Asian fixed income space, there are a couple of places where we find some value. For example, India and Indonesia, some of the high yield bonds in US dollars still offers value. For example, for Indonesia, we like the coal sector and we like the property sector. For India, we like the solar and wind power energy because the bonds are 2 to 3 years and gives us a yield of about 5.5 to 6%. So we find it attractive for our portfolio. And we also like some of the local currency government bonds, both in India and Indonesia, 1 to 2 years, which offers us a carry of about 6 to 7%. So if even the currency weakens by 1 to 2%, we still get a yield of about 4 to 5%. So this is where we see value generally in the Asian fixed income space. We also see some value in China property bonds because we do believe that Chinese property bonds do offer value, especially for 2 to 4 year bonds, roughly giving a yield of about 5 to 6%. As we all know that the property sector is very important for Chinese GDP growth. So for example, if the global economy is slowing, China will make sure that the property market doesn't collapse. So from that perspective, even Chinese property bond offers value. Now you ask me where do I see risk apart from the slowing global economy? The biggest risk I see is the long end government bonds. As I mentioned that actually most of the rates are negative. For example, in Japan and Europe, the 10-year and 30-year bonds are almost zero or negative. So the biggest risk will come from this massive sell-off in US treasuries, Japanese government bonds and Euro government bonds, especially in the long end, the 10-year, 30-year bonds. So that is where we will see a biggest risk coming for all the fixed income portfolio, and that is one of the reasons that we are reducing our fixed income duration. Okay, in terms of local currency bonds, we do like Asian local currency bonds. For example, India, Indonesia and Philippines. In India and Indonesia, the 1-year bond is giving me a yield of about 6.5 to 7%. Of course, we do take some currency risk, but so far the dollar has been very, very strong. But it's the first time we have seen some weakness in the US data. For example, yesterday the ISM manufacturing came much weaker than expected. So a lot of people are pricing in another rate cut in the US. So as US starts cutting rates, we will see the dollar will be peaking. Actually, we are expecting the dollar to peak sometime end of September, but still the dollar is very strong. So once dollar starts weakening, then we will see a lot of value in the local currency bonds. But even if the dollar doesn't weaken, actually the 1-year India and Indonesian government bonds offers us a carry of about 6.5 to 7%. So even if the currency weakens 1 to 2%, I think 4.5 to 5% is still very, very attractive. So this is where we see a lot of value in the local currency government bond market. Okay, Maybank Bluewaterz Total Return Bond Fund is very, very unique. Basically, it is unique in the sense that I can buy both local government bonds and I also buy US dollar corporate bonds. So, for example, if people are very worried about slowdown in the economy or growth is slowing and they are expecting a recession in 2021, then I can move the entire portfolio to government bonds. I can sell every corporate bonds. The second key differentiation of Bluewaterz is that I can raise 100% cash. So, if I see some geopolitical concern or big risk even coming, I can sell everything and put in fixed deposit. So I can use as a fixed income fund or a money market fund. So I can constantly switch between fixed income and money market, as it's a very active managed fund, and the fund can have almost 100% cash. Over the last 5 to 6 years, we've been having almost about 60 to 65% cash whenever there's uncertainty in the markets. So these are the 2 or 3 key points which differentiate Maybank Bluewaterz Total Return Bond Fund. I will just summarize the points. First of all, it can buy both local government bonds and US dollar bonds. So from time to time, we can switch between these 2 markets. Second, the fund can have up to 100% cash. So especially when there are geopolitical risk, we can move from fixed income to money market. And actually the third is we can go long end bonds or short end. So we can move between 10-year duration to 3-year duration. So it's very active management. So that's why Maybank Bluewaterz is very unique, and it is a good investment for most of the investors who wants consistent return and capital preservation. I think I forgot to mention the most important point for Bluewaterz is we want to give consistent return but with capital preservation. So we don't want to give very, very high return, but we want to make sure our returns are consistent between 5 to 6%. At the same time, we want to preserve the capital by raising cash in times of uncertainty.